to Skewing Your Diversification, and I'm your host, Mark Shore. And as you know, this show is all about alternative investments. So tonight we're going to be talking about something a little different we haven't talked about before. If you've stayed in hotels, probably attended some events at hotels or parties, perhaps ordered a drink or two while sitting poolside, or waged a few bets at a hotel casino. But what do you know about investing in hotels? So tonight we have a very special guest, Sabena Arora, a hotel expert, which we'll be talking to about investing in hotels. Hello, Sabena. How are you doing today?
Hi, Mark. How are you? Thank you for having me.
You're glad to have you on the show. Let's see. Just to give the viewers a little bit of your background. Sabena has over 16 years of hospitality real estate experience. She was responsible for evaluating over $50 billion in national international hotel investments and transactions on hotels, totaling more than 12,000 rooms, with approximately 4,700 of those rooms in Manhattan, which is a lot of rooms in Manhattan. She's experienced with transactions involving resorts, timeshare, mixed-use projects, multiple asset portfolios, REITs, and casinos. She's appraised and provided consulting services on more than 200 hotels for corporate and institutional clients throughout the U.S. And Sabena holds a BS in Hotel Administration from Cornell and an MBA from the University of Chicago Booth School of Business, which is, you've got a pretty rich background in the hotel industry.
It's the best form of real estate.
That's what people say. You can actually enjoy the real estate, which is the best part about it.
Exactly.
Let me ask you. You're right now. You're based in Jersey City, New Jersey.
Yes.
And are you originally from there, or did you move there?
Actually, born not too far from you. Actually, where you are in Chicago. I was born in Chi-Town. But my family worked their way to the East Coast and was raised in New York, but ended up in Jersey City. I don't know if anybody's familiar with the East Coast. Jersey City is the new Brooklyn. It's all about land value. But have been in the hotel industry for a long time. I grew up in the industry. Actually, my father worked for back in the days, Holiday Inn. He was a troubleshooter, so he was a GM general manager who traveled from hotel to hotel and coming in and finding problems and fixing them, and he was a turnaround specialist. So I grew up in the industry, and basically up until I was about 6, I traveled the Eastern Seaboard and lived in every major city on the Eastern Seaboard. So, and lived in the hotel. Literally was born in the Chicago Heights Holiday Inn.
So you have it in your blood then, in one way or another.
Yes, that's for sure.
That explains your passion for this industry.
I don't know, passion or just the fact that born right. I don't know. But anyway, yes, I love it. I do love the industry, though. It's the only form of real estate that you can touch and feel and has a personality.
That's actually a really interesting point. With that, let me ask you, because I mean, you focus a lot on the New York real estate market, or hotel real estate.
Yes.
And with that, I know there's a lot of history that goes with it. So can you give like a little bit of background as to some of the history with hotels in New York, and kind of like, you know, bring us up to where we are now?
Well, my experience with the New York City real hotel market is not as long. I really began in 2005, so it's not as long as you'd hope, but it's about 10 years. I've been in New York City for 10 years, about. And let's put it this way: in 2005, the market hit great tides, because what was happening prior to that was a lot of hotels were being converted back into residential use. So that actually had a great impact in the lodging market in New York, where you started seeing occupancy. New York is always a 90s, 85+ occupancy market. No matter, I don't care, you know, I can't speak to prior to the 2000, you know, in the 1970s when the market was totally different, but since I've known the industry, it's always been an 85+ market. In 2005, it was really good for the city because you had a lot of hotels actually being converted had been converted into residential. And
What was causing that conversion to occur, that trend?
Just didn't we have a nice little residential boom?
So they're trying to cash in on that boom.
Right.
Okay.
But then thereafter it became, as the market became frothy in terms of rate for the city, you see a lot of new hotel supply peak up. So then we had a huge mass supply between 2007 to 2009. Basically, you had a ton of supply just popping up into the city. A lot of projects did fall out of the cracks in 08, 09 when we had our Lehman debacle, Lehman/Bear Stearns debacle. But eventually, the market has gangbusters. And just to give you a point of reference, actually, I think I was reading somewhere that, not even reading, but just counting, now we are back to our 2007 levels in terms of room supply. In New York now, there's going to be another 11,000 rooms by 2016, bringing the total to about 110,000 rooms. Okay. And we in New York have not had that pop since 2006/2007 in terms of supply.
That would also make the assumption they're expecting a lot more visitors coming to New York then.
It's interesting you say that because, New York, the number that I always remember in my head, and, statistically that it's just the standard is about, about 50 million visitors a year. And I think now that number is like 54. Like last couple of years it was 52, and now it's 54. But seriously, in New York, I sometimes wonder, is that really what's driving the tourists, or is it the corporate demand that drives New York too? Because another 2 million room nights it's not that big when you think of 50 million already.
That's what I was going to ask you, because is it spread out around the city and the boroughs, or is it pretty much focused in one or two areas?
No, it's New York. It's Manhattan. There's nothing in the boroughs. The boroughs don't get any overflow from the city. People try to think that, Brooklyn and Long Island City and now even Jersey City are like these overflow markets for New York. Yes, they are to some degree. Long Island City has been really trying to make a niche for themselves and try to open a lot more. They have a handful of small boutique and not independent, but franchise, like Holiday Inn and Courtyard and Residence Inns popping up in Long Island City, but there's enough demand also in Long Island City to support that, plus the overflow from the city. But at the end of the day, what's driving demand in Manhattan is the tourists coming in and the corporate travel that's coming in.
So is that primarily Midtown then, where most of the expanded rooms are going to be?
No, actually, it's across the board. You'd be surprised. Things are popping up in Harlem. A lot of things are popping up in downtown, Soho, Tribeca, Nomad. I would say south of 34th Street.
Okay.
South of 34th Street and a spatter up and then, Upper West, East Side, spatter. And then, Times Square, Bryant Park, ton of supply too. It's across the board. I haven't actually studied the percentage of. I can tell you back in 2007, 2008, 2009, a ton of it, I would say like close to 30%, 30 to 40% was south of 34th Street, both on the east and west side.
Okay.
Now I think it's a little bit more scattered, but definitely still a good majority below 34. I'm just here. I was talking about the outer Brooklyn. Here, there's 10 of those hotels are coming up in Queens, 9 are in Brooklyn, and 3 are in Staten Island. So, yeah, that's about 30% of the 84. But the 9 in Brooklyn will be overflow, a little bit of overflow, but not a lot. Brooklyn is actually, if anybody out there who is local to this area would attest that Brooklyn has become its own little hub. You know, there's just so much gentrification. It's similar to near Wrigley Field, the gentrification that happened up in there back in 2000, you know, between 1998 and 2002, where you saw a lot of commercial and condo boom up there. The same thing Brooklyn has. I mean, Brooklyn, and it's it's Brooklyn, it's New York. So anywhere you can get build condos or apartments, it's done. And every piece of square inch of Brooklyn, they're doing it. That's for sure.
I remember too when I used to live in Jersey City back in the day when I lived out there. Even there, I mean, as you started to see more offices coming in, buildings going up, there were hotels that were starting to pop up, and because you know that they're servicing, you know, some of the residents, but they're also more or less servicing the office buildings that are there.
Yep. Yeah.
So let me ask you something. I know there's been a lot of changes in hotels and the concepts over time. So when you look at, say, the evolution of the franchise, the brands, how has that evolved over time?
It's evolved in the way that any way a franchise company can keep making money, they'll. It's like, okay, let's make another box, change the shape a little bit, and put on a new name, and still keep collecting our 8% of revenue. So the evolution has been more based on money. I don't think it is as creative as it could have been. Except for there's a few evolutions of brands that I think have been amazing, or creation of brands that have happened, but they're not necessarily franchised brands, such as like the W. I mean, what Barry Sternlicht has done with Starwood brands, such as the W, is amazing. He revolutionized what a boutique hotel would be in terms of a brand, as creating a boxed boutique.
Okay.
And making it very successful, but that's not a franchise. But it's I'm sorry if I'm going to curse. It's like bastardizing the company of the brand. It's a brand. It's just look at Hilton. I mean, again, they've got.
And then Hilton has its subsets.
Right. And Marriott. They've gotten rid of their Fairfield Inns and they're putting up Staybridge Suites now. They don't do too many new builds of Fairfield, and that's, I don't know if you know, Fairfield Inns are the limited service level of hotel where you get your continental breakfast, which is not even really a continental breakfast. It's not like a real warm breakfast, but you get your bagels, donuts, and so forth that's wrapped into your rate, and you can any average Midwest Fairfield would be $79, $89, dollar kind of rate, and they're not even building those now. They're actually replacing a lot of those exterior quarter or old box Fairfield Inns with Spring Hill Suites.
Okay. Which
is a new concept. Again.
And how is that different?
New name, new box, new prettier, new furniture, bigger flat screen TVs. Granite on your armoires versus the solid wood piece. I mean, it's nothing. It's just another brand to build fees.
Okay.
Same thing with Hilton. Hilton realized, that there's an extended stay market below their their Homewood Suites. So they built the Home 2 Suites, which is kind of to compete with the microtels of the world and the extended stay of the world. Okay. So, again, it's a box, and it just adds more supply in certain areas and certain tertiary and secondary markets. And yes, it is good. It does create, there is something good about developing new product, new brand. But at the same time, if I'm a hotel owner, I get a little concerned. How much are you diluting the essence of a brand through more supply? Because now I've got to still share a 1-800 number. Yes, there's tons of ways of booking a room through all these different internet services of Expedia and stuff, but still, as a owner, I'm giving the rooms to Expedia at a discounted rate already. And on top of that, even though it's still not going through the Hilton channel or the Marriott channel or the IHG channel, I'm still discounting the rate, plus I still have to pay the brand an X percentage on that revenue because I generated that revenue. So, you know, it hurts at the end of the day, but you can't survive without a brand.
Let me ask you this, because do you see that there are particular trends that are occurring now or occurring more recently that the hotel industry is starting to chase after or, you know, to focus on?
Technology, changing technology, the way of getting to the customer before, especially the brands are being smarter about how they're using technology and booking on their own sites versus, you know, through Expedia, Travelocity. I think also hotel owners are getting smarter about having to use technology on their own websites, especially multiple properties. When an owner has more than one property, owning multiple properties, and actually trying to revenue maximize all those units on their own website.
Okay.
I think the industry's gotten way smart on how to deal with I mean, it's not just a back in the day when I started, it was like a day-to-day of how you change rates, and you know, you're manually putting in rates. Now it's evolved from being daily to hourly to minute in terms of rates being changed.
Oh, really?
Yeah.
They're moving that fast.
I wouldn't say minutes, but maybe it is within. It's less than an hour now.
Okay.
You know? So I wouldn't say it's like speed trading. What is that? The whole that
high frequency traders.
High frequency trading. I don't think it's that fast yet. Again, but I wouldn't be surprised one day if it is. And yeah, I think the use of technology has been amazing for the industry. And as an investor, I also think things are changing in terms of a lot money, private equity money, and institutional money that uses hotels as an investment vehicle are actually now appreciating the management companies more than ever, I think, because people are realizing now management companies are just as fee generating as franchise companies. Because recently I've just been hearing that there's been a handful of management companies on the block that actually want to sell or trade, want to be bought, that are trying to be traded.
Actually, can you explain that a little bit, like the difference between the franchise and the management companies, so that everyone's familiar with what those differences are?
Well, franchise is, i.e., like you go to McDonald's. You ever been to McDonald's?
A couple times.
Okay, so McDonald's, so you go to McDonald's. That owner of that McDonald's in Edgewater, he is paying a fee to McDonald's for the brand, correct?
Right.
And on his financials, he's probably charging him a management fee. Well, maybe I don't even know. I can't even use that as an example, but I apologize. I should take that back. Let's put it in the hotel perspective, because I don't know how. Basically, a management company is basically the company that comes in and is just running the day-to-day operations. Okay. The franchise company is just the guy who's allowing you to use their name, use their systems, their marketing systems, their technology, and any other technology of purchasing power. And that's it. That's what you're getting for your 8% of revenue. You're paying to put their logo on, to use their pens with the Hampton Inn or Marriott name. And
so the management companies then are charging 8% to the franchise?
No, management companies generally charge 3 to 5%.
Okay.
So that's a separate from the franchise fees. The franchise fee on average is about just your base fees, and there's on top of that there's other little fees like technology fees, but I generally when you call national marketing plus the royalty fee plus your res fee, it's about 8% plus all the other little crap that could add up to 10%.
So,
And it depends on brand by brand. I mean, each brand is a little bit different, but on majority, it's 8 to 10% of your revenue.
okay. Let me, to change things.
Just the management company is generally 3 to 5% of your revenue.
Okay, just for that portion of it.
Yeah.
To change things a little bit, you do a lot of analysis of hotels.
Mm-hmm.
When you're out there looking at them and looking at these potential transactions, what are some of the major factors that you look for, and what are some of the pros, the good things that you're looking for, you like to see in a hotel, in the deal, and then what are some of the things that might be red flags or reasons for concern that might say stay away from the deal?
Location, location, location.
I've heard that somewhere before.
Good bones, good box. Looking at the box, if it's a good box. I mean, especially in the first tier cities, you want a good box, a good location, and good bones. And if that all works, the brand is always replaceable in some way or format. Renovating is always easy too. It's location and the good bones. If you
When you
have
say bones, you mean the structure of the building?
structure of the building, yeah.
Okay.
Because can I finance this property? Is it financeable as is, or what do I need to get it to be financeable? I mean, that's a big what if, especially, and this is not like it was in 05, 06, 07, where we were getting 80%, 80+% financing, and it was great rates. Now you're lucky if you can get 75, and rates are what they are. It is what it is now. And even though it's low, but you're trading it off at low LTVs. What else would I tell you? Supply. Supply is a big thing. Being very cautious about how much supply is coming in your market, what kind of brands are on that supply set that's coming on board, and those are the key things that I would look at. And how deep and if you're coming in, and if it's let's say if you're when you say analyzing, are you talking about existing or for development?
Let's start with existing.
Existing, yeah. Location, good bones, supply. Can I finance this? And in terms of what can I do to turn this property around? Is it the brand? Is it renovating? What's the story? What's the and that's what it is, a story. It's a pitch, because when you're buying, you're putting basically a new business plan together for that property, and you're trying to figure out what will fit well for that location and that structure, and for the demand generators that are coming into that area.
Okay, so potentially, I mean, you've got a hotel that's there now under a particular brand. They're selling it, and you could either put in the same brand, or you could potentially get another brand, franchise.
Well, it depends on the terms of. I mean, again, it depends on if that property is already locked into a brand. It's locked into the brand for X number of years. So,
regardless of who's running it.
Right. I mean, it depends on the franchise agreement. Yeah.
Okay.
And some franchise agreements are terminable on sale. They're not. And first of all, not even can they be transferable on sale? Sometimes they have to get approval from the brand before you can just actually transfer the brand.
Okay. Which opens. Okay, so that potentially limits you on to what you can do with it, or or it can open up a lot of opportunities. So it depends.
Exactly.
Okay.
So you're hello?
Yeah.
Sorry about that. You froze out for a bit.
So let me ask from the other side then. If you're developing a new property, so there's nothing there, what are you looking at? What sort of factors would either make you say yes or no to it?
Demand. I mean, demand, supply, existing demand, existing supply. How deep is the market? Can it support another hotel? I mean, it's funny. Not recently. I'm working on some work for a client, and they have in a tertiary market, and it's in a tertiary market. that it's not even in a city that you would think of, that it would even cross your mind that there's demand out there, but supposedly there's a ton of manufacturing demand, automotive demand, and it's not Detroit. It's more of parts for the auto industry, trucking industry, and so forth, and other different various industries. And that market only had like 400 rooms, of which are old product, exterior corridor, Ramada, Quality Inn, like very old dated product. And they have the only, and I'm going to make up the brand, I'm going to just say they have the only Fairfield Inn in town. And that's the newest one in town. But and that Fairfield is outpacing the comp set tremendously. Like the property is running 80% versus the comp set running like 50-60%.
That's good.
And it's good. And the only reason that even the Arora, Quality Inn are even at the 50-60% is because there's so much demand locally that the corporate travelers coming in have no place to go.
Okay.
So this owner has recognized for the fact that there is such a deep pocket of demand that they're building 3 more hotels. So they're increasing the supply of this tertiary market from 400 to basically 800. They're doubling it, nearly doubling. But and this goes back to the point of like, well, what do you look for? How owners you're going to be able to market it to actually create cost effectiveness in terms of purchasing and technology, sales efforts, revenue management. So that goes back to how technology has just evolved for the industry. But now they're going to control this market. And what's interesting is that this market doesn't even have a hotel that has meeting space. So they're actually going to build a courtyard with a 10,000 square foot ballroom / meeting rooms and so forth. And typical courtyards do not have more than 3,000 square feet of meeting space.
Okay.
This is 3 times and the market's not deep enough for a full-service Marriott to build a full-service 250-room Marriott with 15,000 square feet. So you're going to go down to a courtyard, which is the mid-tier Marriott level, 110 or 120 rooms, whatever the number count they have, plus 10,000 square feet to get those corporate groups that need space to have their annual meetings or sales trainings or Christmas parties, so forth, whatever. And there's probably a wedding social market as well. So, but it's just very amazing how, and there you talk about brand, they're actually building 3 Marriott products together. They have 1 existing Marriott product now, and of those 3 other hotels, they're building 2 Marriott products. So now suddenly the market is going to have 3 hotels out of the 8 that are Marriott. Different tiers, but all Marriott.
But they also see it. There's a growing demand in that market.
Yes.
Otherwise, it wouldn't make sense for them to do it.
Yes, it is a growing. I mean, again, it's a small city that just expanding and has expanded and needs that. But I wonder, is it going to happen for the long term? I don't know.
Okay.
Well,
let me ask you this, because
is it a market? I.e., you build another hotel in New York. No, you're not going to lose money as long as you're not overpaying for the dirt, for the property itself. You know what I mean? You're never going to lose money. Whereas there, there could be in another recession. Tertiary market that only historically has been surviving for the last 15 years on 4 hotels is now suddenly going to 8.
Yeah, if the market softens up, will they be able to survive? Yeah. So let me ask you this, because if you look nationally at the hotel industry, do you see certain parts of the country there are different trends, or there's different ways to make it profitable? Like something that happens, in the South is very different from what happens like in the New York area, or what happens on the West Coast is different from the East Coast, or anything like that?
Yeah, definitely. I mean, the union issues are a big problem, for California, for San Francisco, Chicago. New York has its share too, and I think the South, the example of the tertiary market that I gave you, where labor costs are definitely cheaper, which helps in terms of operations. But it's interesting you say that because the other day I was talking to a developer out in Houston who's just built a huge hotel in downtown, and they've been sitting on a couple of pieces of land also in the Dallas/Lubbock area and Austin, and they're reluctant to actually continue on building another building because labor costs have risen so much in the Texas area, especially like Lubbock, Dallas, and Houston, because there's been such a huge construction boom because of the oil industry, that it's not inducive for them to actually build, even though they've been sitting on this piece of land dirt cheap for the longest time. They're going to wait it out a little bit more because when they do the math, it just doesn't make sense for the labor costs. Okay. And the labor cost is because there's just so many construction companies, and if they're in demand, they're booked. And even if you try to get them, they're going to ask for a premium at this stage of the game. So I definitely think there's different dynamics regionally versus overall regionally. I mean, New York, you never go wrong. It's just a question of can you get financing?
Yeah.
You know, because it's always, you know, the bank, that's their hometown, and as soon as things go bad, they're quick to turn off their, you know, to turn off and lock the doors. It depends, you know, and it was interesting, well, you know, after '08, how the regional banks became and the local banks became the best friends of a lot of owners, the multi-property owners, the guys who had the 3 to 5 to 6, you know, units, you know, who were trying to get their debt from Wells Fargo and JP, and you know, now suddenly have to stop and go knock on Main Street Bank USA, you know.
Yeah, the local banks.
Yeah, it was very interesting, and a lot of them also had, a lot of the banks locally also were on a hold pattern too, as you know. So
yeah.
But the few deals that did get done during that time were definitely your local and regional banks, not the nationals.
So okay, so they're the ones that are coming in and trying to support the local community, where the large ones, well, the large ones too had their own issues.
Well, they were doing it to a degree. They were doing it very tempered. I mean, it wasn't like they were just, you know, handing out loans. You know, it was definitely still relationship. But whatever deals did get done that I saw after '08 were definitely with the local banks.
And was it the larger banks, were they really working with the big major brands, whereas the local banks were dealing more with the smaller regional brands or the local brand?
I think it was across the board. Yeah, but the larger, and when you say larger brands, I wouldn't say large, I mean larger owners.
Yes. Yeah, the larger companies.
No, I would say that the relationships were still there. I mean, because I worked on a couple of assignments where Blackstone was getting refinance deals done because they had such a deep relationship with Wells Fargo. Wells Fargo was not going to say no to Blackstone. Right. So there were still, you know, refinances, opportunity, acquisitions that still were happening, but not to the degree that you saw in '06, '07. But you know, that's not just the hotel industry. I mean, everybody thinks of all the big deals of like, i.e., you know, Interstate and all the REITs like Ashford and Sunstone and Diamond Rock, all these big hotel companies and REITs and so forth. But you forget there are a lot of owners, you know, the guys that own the 5 to 10 units that still run this industry. You know, they actually, you know, they're, you know, in volume, they still own more rooms than the Sunstones and the Diamond Rocks and, you know, so forth of the world. So they, you know, and they're branded properties. These are still Hiltons, Holiday Inns, Marriott, you know, Courtyards, and so forth. So, and those guys had to knock on their local banks. I mean, these are guys who started off with 1 or 2 properties, going to their, Bank of, of Smithtown for a loan. You know, it's, you know, Bank of Smithtown's not there anymore, but that actually got one of the debacles of '08 as well. They had to sell out to People's Bank in Connecticut, but here, People's Bank being a small local bank, that's where people were going. I'm actually seeing a couple of hotels and commercial deals being done by like Investors Bank, which is a local bank, a regional bank. It's not a national bank. Definitely, it was a change in environment. The CMBS market did really rock the hotel industry.
Oh, I'm sure, in a very big way.
During my time between 04 to 010, I saw properties that I was involved in the acquisition where we buy the property for $200 million, and a year and a half later, we're now recapping at 300 to 350. Then recapping again at 400, and so forth. So, and where is that going? To the CMBS market. So, it's fun.
Let me ask you, for investors who are looking to get exposure into the hotel industry, I know that there's different vehicles, different structures. What would you say are some of the more common ones? Because you can do it, through private equity. You could do it through real estate. You can do it through REITs. So what's
the stocks are there. You've got the hotel, Marriott, Starwood, Ashford, Diamond Rock, Pebblebrook. RLJ has Ashford just spin off. They created Ashford's a big REIT, and they were realizing that they couldn't get enough financing because they had because REITs, again, it's very hard for REITs to get financing, and they spun off where they put their premium assets into Ashford Prime.
Okay.
It helps them bolster, their financing capabilities. Who else is there? I'm trying to think of other. You've got Chatham, LaSalle is a big, huge. They've been on the go. LaSalle just bought a year or two ago the Park Central in New York. They're Felcor. Felcor is.
Who's Felcor?
Felcor's out of Dallas, another REIT. They're actually they've been under contract, and it should open now soon. It's a Hilton Garden Inn in New York. They just acquired that a couple of years ago, but that was a new construction, so now it should be up and running. I haven't checked. It's been a while since I've looked into all these. But Hersha's another REIT, and they have very deep ties with Starwood and Starwood Capital. That's another good one to look at. Sunstone, I think I've mentioned to you. You can look at the hotel companies. Wyndham, their CEO just left to join a hotel company / management company in New York called Hampshire Hotels.
Okay.
So that's a company to look. I don't think that's ever going to go public, but Hampshire, you never know. I don't know what their long-term outlook is, but that's another hotel company. Morgan's Hotel Group. There's been a lot of activity with that. There's been a lot of that. I think Morgan's will not one day exist. I think that's going to be totally broken up. You got Choice. Choice is a public company, but it's a franchise company, pure franchise fees. That's the Comfort Inn brand, Sleep Inn, Quality. I don't know if these names ring any.
Yeah, some of the smaller
brands. Select service product.
Yeah.
They are trying to expand. They have a new brand called Cambria Suites, which is like an extended stay product to kind of compete with the Homewood / Residence Inn product. It's not new, but it's a brand that they've been trying to. They actually have one in the works near Bryant Park, between Bryant Park and Times Square on 42nd Street, with Extel. I don't know if you ever heard of Extel. They're a huge developer in New York. They're locked into a Cambria, and they're actually giving key money some of these companies are giving key money to certain owners.
When you say key money, meaning?
Free financing. Here, please open our brand, and we'll give you $3 million. Or even when I say free money, some of them are yes, don't pay us back. Some are like pay us back by year 3, year 5, whatever, but no interest, basically interest-free money.
So they're incentivizing
Yes.
the guys to open up their brands for them.
For the right developer, right location, yes.
Okay.
I don't think they're going to do it in Tallahassee, but New York, San Francisco, certain, markets, yes.
Yeah, that's interesting.
Trying to think of other REITs that, but REITs, the hotel, Marriott,
Yeah.
Marriott's always a good, you're never going to lose money with Marriott. You're not going to lose money with Hilton. Back in the day, I would say prior to Blackstone controlling Hilton, you would, but now Blackstone, runs the reins of Hilton.
So I mean, primarily the REITs are the best way to get exposure to the hotels.
And the stocks. I mean, when I say Marriott, Hilton, those are companies. Those are traded on. I'm not sure where they're traded, but those are stocks. They're not necessarily REITs. REITs are definitely an opportunity too. I do think the yields on the REITs are going to pick up a little bit. Every time when I look, last time I looked was like, a couple months ago, and I remember like dividends of like, I think, because I actually own Felcor. I think Felcor was like 2 or 2.5 or 3%, but I can see that coming up. I'm trying to think what was the high, like Host. Host is a good one. Host, you're not going to lose your money. Host is like a steady Eddie 5-6 Host.
Who is Host? Yeah, I'm not familiar with them.
Host Marriott is actually a REIT, and mostly it's a spinoff of Marriott. I don't know when they spin off, years and years ago, and became a REIT of the when they did spin off, it was like the premium product of Host. It's like JW Bill Marriott's has stock in Host Marriott. It's like family money is still stuck in there. And that's a very good REIT. They're always giving 5-6%. I don't even know what they were doing back in the day when the market was down, but I'm sure it was still 5-6% in dividend yield. So that you're not going to go wrong with Host. And what else can I think of?
Well, I'll tell you what, because we're starting to run out of time.
Oh, we are?
Yeah.
Okay.
So I know you could talk about this stuff for days.
No, I can't. I wish I could.
Actually, one last story, though. I don't know if I ever told you this. Because you and I, we've known each other, I don't know, what, 10, 12 years, something like that.
Since 01.
What?
We met in 01. We met in 01.
Was it 01? Okay.
Yes.
So, yes, it's been quite a while. I don't know if I ever told you the story that my grandfather had a manufacturing business where he manufactured furniture. Mm-hmm. And he started his business in the midst of the Depression, so back in the 30s. And then basically it lasted for about 40 years. So he did a lot of contract sales, sold to a lot of hotels, motels. So he knew a lot of the original owners and families that started these hotels.
Mm-hmm.
Going back to the 1930s and 40s and things like that. He knew a lot of the guys, that were running the early days of, Vegas and different parts of the country. Because he sold to all of them, so so he knew all these guys, and it's kind of interesting because he just like you think about it now, and it's like okay, it's multiple generations, or it's been sold off, from the family to a corporation, but he knew them when they were just starting, in their early days. So it's kind of interesting. With that being said, if anyone wants to get hold of you, what is the best way for them to reach you?
Email me, I guess.
Which would be?
SabenaArora@gmail.com. That's SabenaArora@gmail.com.
Okay, cool. And if anyone wants to reach me, they can reach me on Twitter. My handle is @ShoreCap, or they can go to my website, which is shorecapmgmt.com for Shore Capital Management. And Sabena, thank you very much for being on the show. We look forward to having you back again sometime soon.
Thank you. I appreciate it.
All right.
My pleasure. And to everyone out there, until next time, remember to skew your diversification. Bye-bye.